Assalamu alaikum, dear students. Hope you are well. Today, I am going to take the second class on the contribution of financial leverage and capital structure. Okay, let's see. In the whiteboard, I write down a question. Uh, Khan International Limited has sales taka 1 lakh. Its variable cost CGS, CGS, cost of goods sold is 60%, variable operating expense is taka 20,000 taka, fixed operating expense is 0, there is no fixed operating expense. Business capital includes equity share capital of taka 1 lakh taka divided into 1000 shares of taka 100 each or per share, and tax rate is 50%. So the change the EPS if sales become double. If we see the question, what we see in this question, there is given, Khan International Limited has sales taka 1 lakh. We should bring out the EPS of sales taka 1 lakh, and then we must bring 2 lakh from the sales of 2 lakh. What's the EPS? Okay. Good. We see the question. Then, above the question, please. Above the problem, we see that there is no fixed operating expense. Expense, which is called operating expense. Okay, there is no interest. There is no interest on the fixed financial charge is on, we want to say that, bond or debt or financial leverage. Okay, we see in this question there is no fixed expense in it is which is operating expense, and there is no interest. I think we want to say this fixed financial charge is like on bond or debt or financial leverage. Okay, it is assumed that if leverage if leverage I think operating or financial is favorable and sales increases that time, and on that time EPS will increase at more proportion. Okay, so we can say that what is written here, it is assumed that if leverage, leverage two kinds here, two kinds, operating and financial. It is assumed that if leverage operating or financial is favorable and sales increases, sales increases, whenever sales is 100 taka, then it will be 200 taka. When sales is increases, and on the time EPS will be increased at more proportion to the sales, more proportion to the sales. Okay, at present we see the effect of the change of the sales may be shown as follows, or we can see in the way. Okay, let's, dear students, at present I erase the total, all of the question. I expect that all of you must write down the question in your script, because I should erase or delete the question because of lacking the space in whiteboard. Okay. Here, question. In this question, I think, say, particulars sales 100%, table 1, then second one is sales become double, 200%. Okay, it is called table 2. Just I write here table 1 or 2. Why I write down it is because we can easily compare two tables. Okay, dear students, here in the question, total sales, net sales, 1 lakh taka, and then if it double, then the sales will be 2 lakh taka. Okay, good. So let's see CGS. CGS means cost of goods sold. Cost of goods sold is 60% of sales. 60% of sales. For that, 60% of 1 lakh is 60,000 taka, and 2 lakh is 1,20,000 taka. Okay, it is 40,000 taka, and it is 80,000 taka. It is called gross profit. It is called gross profit or gross margin. Okay, then in the question there is variable operating expense. Variable operating expense less total variable expense. In total variable expense, one is variable, which is 20,000 taka, variable 20,000 taka, for 1 lakh and 40,000 taka for 2 lakh, because it is double. Okay, so it is 20,000 taka and it is 40,000 taka. Okay, here there is no fixed variable cost. It is total operating variable cost, I think so. Total operating expenses here. So there is no fixed operating expenses. So we should uh, deduct variable operating expenses, which is 20,000 taka on 1 lakh and 40,000 taka on 2 lakh. Okay. Okay. It is called income from operations. It is called income from operations. Okay, it is called income from operations. At the time here, you should add which items you should add. You should add which is income. I mean other income, or others income. Okay, others income. I mean others income may be interest or dividend. Okay, in the question there is no others income which is interest on dividend. Okay, there is 0. Okay, so it is called total income. Okay, it is called total income. Okay, at present we less which is others expenses, which is called, I mean financial leverage, I mean fixed cost, financial fixed charges, which is financial fixed charges, or dividend. Fixed charges, I mean interest. Okay, it is called, here is 0, there is no dividend income or interest income. Okay, sorry, interest expense. It is 20,000 taka and 40,000 taka. Okay, it is called EVIT, others expenses. Okay, it is called EVIT, earning before interest and tax. Earning before interest tax, it is 20,000 taka and 40,000 taka, less interest, there is no interest. Okay, so 0, 40,000 taka and 20,000 taka. Okay, it is called EBT, I mean earning before tax. Earning before tax. Okay, earning before tax. At present we deduct tax at 50%. Okay, tax at 50%. I mean income is 20,000 taka, tax is 50%, I mean 10,000 taka. So it is 10,000 taka and it is 20,000 taka and the result is 20,000 taka. Okay, it is called EAT, I mean earning after tax. EAT, I mean earning after tax. It is called profit available to the stakeholders or shareholders. Okay. Okay. Total outstanding here. Total outstanding shares. Total outstanding shares is 1,000 share, which is 100 taka per share. Okay. So EPS is earning per share. EPS is 10 taka and EPS is 20 taka. Okay, here we see that what is the changes in EPS when the sales become double. We see that EPS changes. We see that EPS changes is say 20 taka minus 10 taka equal 10 taka. So 10 by 10 into 100, we see that 100%. Okay, in the question we see that if the sales become double, then EPS become double. Okay, it is assumed that we can say that if we see the question, if you see this problem solution, we can say that there is no leverage. There is no leverage on that time. There is no leverage on that time. EPS or sales become double, then EPS will increase at the same proportion, same percentage. Okay. Then I want to say that, okay, we see this in the question, in the solution, and we also see that if it is assumed that if there is no leverage, and sales increases, then EPS will increase in the same proportion. Okay, here I want to say that if there is no leverage, I mean there is no operating leverage and there is no financial leverage on the time, and sales increases. I mean, if sales is 100 taka, then if sales become double, then EPS will increase in the same proportional percentage. Okay, if there is either operating leverage or financial leverage, and sales increases, then EPS will increases in same proportion. Okay, then if both of the leverage, we can say both of the leverage, I mean operating leverage and financial leverage, both of the leverage is here and sales increases, then on that time EPS will increase the multiple of, increase the multiple or multiply, we can say this multiplication table as like that, increase the multiple of degree of operating leverage, and which is called DOL, degree of operating leverage, DOL, and degree of financial leverage, which is called DFL. The combination of DFL and DOL, it is called DCL, degree of combined leverage. Okay, so in the math, in the problem, we see that if there is no leverage and then sales increases, on that time EPS increases at the same proportion, at the same percentage. Okay, if one is here, I think one is in the problem, one leverage is problem, it is maybe operating leverage or financial leverage, then on that time EPS will be increases at the same proportion. If both of the leverages are here, on that time EPS increases in the mode of the multiple of degree of operating leverage and degree of financial leverage. It is called DCL, I mean degree of combined leverage. So in this question, in this solution, in this problem, we see that when there is no leverage but sales increased or sales become double, then EPS will be double or will become double. I expect that all of you solve the problem at home. Thank you.